Hey, good evening everyone. Marty Mazzara here with your second video today. This one is our weekly economic update. I can keep it really short. In front of you is our index, PWA macro or general conditions index. Took another leg lower this week. We went from a -2 to a -4. Nothing actually went from positive or neutral to negative. We just had a couple data points, two or three, that went from positive to neutral. Right? So nothing falling off a cliff, but weakness enough to impact overall score. This says that we are getting a little more into what we would call a scenario where odds favor recession going forward as opposed to continued expansion. Let's just touch on a handful of our inputs. We'll start with personal income on a month-over-month basis, 0.2%. That was notably below expectations, so pretty much on the flat line month-over-month. Year-over-year, a healthy 4.6. I mean, historically, you don't complain about a 4.6% rise in personal income, except when inflation via the CPI is running at 8.5%, or the personal consumption expenditures deflator, which I'll show you here in a minute, running at like 6.5%. So that would say that the consumer's income on a year-over-year basis is not keeping pace with inflation, and obviously that's not healthy. And as you might imagine, that reflects in the consumer savings ratio, which continues to drop now to 5.0%. So what does that mean, folks? It means that people are pulling out and spending, although this is the ratio in terms of ongoing savings relative to income. So they're saving 5% as opposed to, saving a lot higher than that. It also suggests that they're pulling from savings. We know that they've been increasing their credit card debt of late. Still not to dangerous levels, but still things that we need to pay attention to. So again, when you have inflation increasing faster than personal income to maintain one's lifestyle, then we're going to talk about pulling from savings, hitting credit cards, and so forth. Again, we see a pretty healthy consumer overall right now, lending itself to an argument for a not so bad recession. However, the Fed is seemingly very committed to their 2% inflation target, and I would argue, and talked a bit about that today on the other video, I would argue that they're going to have to create some serious economic pain. So the recessionary thesis here at PWA could morph into something more serious, and we see it right now based on some of these factors that we'll continue to talk about going forward. So personal consumption has been declining as well. Just a tiny month-over-month increase. Trend, going in the wrong direction. Rate of change, very low, and so on. So consumers spending less money than anticipated, still more than the previous month, but at a slower pace. Stuff certainly to keep our eye on, particularly when we're looking at an economy that is 2/3 consumption. The inflation data, PCE, came out today. So headline 6.3%, back off a bit from the 6.8% from the previous month, which was up from about where it is now, maybe a little higher the month before. Core PCE, which X's out food and energy, 4.5, off of that slight increase the previous month. But as we know, a big part of our budget right now, but at any time, of course, is food and energy. So the headline seems to be what's got everybody's attention. Food and energy comes out of the core because it's so volatile. Of course, we've seen gas prices come down a bit here lately. But at the end of the day, serious stuff when we look at 6.3% inflation versus 4.6% wage increases, and of course a higher print on CPI, which is over 8%, at least at the last reading. And then the Chicago Fed National Activity Index, I wrote a little blurb about this earlier in the week. That actually was surprisingly good. I like this index a lot. It's really an index within our index. They use 85 data points. 55 were positive this month, 30 scored negative, which brought it back above zero. very respected indicator. So that kind of went against the grain in terms of some of the weaker economic data. And it, of course, scored a positive for our index here this week. And then lastly, quick look at commodities. They are coming back, of course, in our core portfolio. That because we do have some commodities exposure, that's helping our relative performance, I guess, relative to stocks. We are long-term structural bulls on commodities, particularly industrial metals, but, on ag, which is a not small position in our portfolio as well. We also see a lot of downside risk, event risk in markets, including agriculture and energy and so forth. So we're continuing to hedge our ag exposure, hedge our energy exposure in particular, and we probably will going forward because we do see global events that ultimately will give us these big spikes lower. Could be opportunities to add at the margin to the extent that we need some more of that exposure because, again, we are long-term bulls. But in many areas, clients, you know this, we are using derivatives to hedge our downside risk. And as I mentioned in the stock market snapshot a few hours ago, we do see significantly more potential for downside, at least in the equity market for a while going forward. So folks, at the end of the day, an economy that is not falling off of a cliff, but still a relatively tight and strong labor market. Chairman Powell talked a lot about that. That, of course, keeps inflation pressures high when you look at the largest expense among businesses. And so he gave a speech today. I won't belabor that here because we already talked about it. That was, pretty hawkish. And when you combine that with what the other governors are saying and what market expectations have been, and alleviation of some of that underlying positional support for the market, it makes sense that we would have the kind of day that we had today. And technically, as I showed you earlier, could see more of this for a while going forward. At least that's our anticipation, and we think that's what makes sense for the market. But of course, it's dynamic, and we'll continue to update you as we update our theses. Hope you have a wonderful weekend. Thank you, as always, for watching and listening. Talk to you again next week. Bye-bye.